I was just here to say that we will start the program in about 5 minutes. So I just want everyone to get seated. But thank you so much for taking care of that for me. So in about 5 minutes, we will get started with Chair Powell. Thanks so much.
I'm here to deliver the 4-minute warning. Not really. Let's get started. Good morning to everyone and welcome to the Federal Reserve Board. I'm very pleased, though not surprised, to see such great interest in the topic of today's conference, the integrated review of the capital framework for large banks. And I want to thank Vice Chair for Supervision Bowman for having the great idea of holding this event at the outset of her term. I'd also like to thank Fed staff for their tireless work in putting the conference together. So today, we'll hear the perspectives of industry veterans, academics, and current and former policymakers who are all well-versed in the operations of large banks and the main pillars of the capital framework. A great benefit of this conference is the chance to consider all elements of the capital framework in concert, rather than look at each in isolation. We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve. The U.S. bank capital framework includes risk-based capital requirements, leverage requirements, the surcharge for the largest and most complex banks, and the stress tests. We will discuss the status of each of those elements and the road ahead in a comprehensive manner today. As this audience will know well, we have proposals outstanding or in the works across all 4 areas. Our regulatory capital framework and all banking rules are implemented through supervision, an area where Vice Chair for Supervision Bowman brings deep experience as a former banker and state supervisor. As she has noted, we need to make sure that our supervisory practices focus on the critical areas that determine safety and soundness. We need our large banks to be well capitalized and to manage their key risks well. And we need large banks to be free to compete with one another, with non-bank financial institutions and with banks in other jurisdictions to provide capital and support economic growth. The Fed is a dynamic institution. We're open to hearing new ideas and feedback on how to improve the capital framework for large banks, and I look forward to hearing from today's participants. Thanks again to all of you for joining us today. Thank you.
All right. Thank you so much, Chair Powell. Welcome, everyone. My name is Amal Vaidya. I'm sure I've been inundating your email box with Capital Conference 2025 emails for registration and logistics. I will go over a couple of quick housekeeping things, and we will start the next panel at 9 a.m. As you know, this is a secure building, so our colleagues in law enforcement do ask that you keep your badges on you at all times. If you need to step out for a moment, anyone who you see that does not have a badge on is Federal Reserve staff. They are part of our events team supporting this great event. They're happy to escort you to a coat room or step out to make a phone call. On that point, we do ask that you silence or put your cell phones on vibrate for the duration of this event. And with that said, we will get the next panel started at 9 a.m. Thanks so much.
go? Good. Good morning, everyone. Before anything else, I want to thank Vice Chair Bowman for setting up this really engaging conference. We learned last night at dinner that this has all happened very quickly, and then this is essentially an unprecedented type of conference for addressing proposals for new rulemaking. So this particular panel has been asked to address changes in the enhanced supplementary leverage ratio, or ESLR, and various other leverage ratio related capital requirements. In the notice of the proposal for rulemaking, the agencies have noted that this virtue of a simple and transparent rule has some unintended adverse consequences, the focus of which in the agency's proposal is the implications for intermediation in the U.S. Treasury market. So what the plan for this panel is that I'm going to ask some questions to the panelists, who I'm going to introduce in a moment, that we have teed up in advance. But in order to keep it lively and engaging, I'm going to get some candid reactions across the panel to each other's comments. And then I'm going to turn it over to you all for questions and answers. So prepare your thoughts and give us some challenging and useful questions, please. So to introduce the panel, to my immediate left is Tiffany Eng. Tiffany is the Global Treasurer of BNY, a financial services company and primary settlement provider for the U.S. Treasury market. Tiffany is a former OCC regulatory attorney. To Tiffany's left is Don Cohn, whom everybody knows, Senior Fellow at Brookings. Don is a former Vice Chair of the Federal Reserve Board and former member of the Financial Policy Committee of the Bank of England. To Don's left is Brian Monteleone. Brian is Head of Global Investment Grade Credit Research and Senior Bank Analyst at Vanguard. Prior to Vanguard, Brian was a top-ranked credit analyst on the sell side, covering global financials for 20 years. And to Brian's left, Hal Scott, Emeritus Professor, Harvard Law School. Hal is also Adjunct Professor at Harvard Kennedy School and Director of the Committee on Capital Markets Regulation. And finally, to the far left is Ben Wiener, partner in Sullivan & Cromwell's Financial Services and Capital Markets Groups. Ben advises banking organizations on regulatory capital, stress testing, resolution planning, and capital market transactions. So I'm going to ask Hal to set us off on first principles. Why do we actually have a leverage ratio rule? And what is the history of this requirement? Do we actually need a leverage ratio rule? And does the backstop rationale for that rule still apply today? Hal?
Thank you, Darrell, and the organizers of this conference. The leverage ratio sets, as you know, a minimum. The leverage ratio sets, as you know, a minimum capital level for bank based on its total value of its assets, regardless of the riskiness of those assets. It operates in parallel with the risk-weighted standards, which set separate minimums that do vary based on riskiness. The theory is that without a risk-insensitive leverage ratio, a bank might be free to expand its balance sheet by acquiring riskless assets without limit. But this is not a realistic model of how banks operate. Banks seek to employ capital to the highest returning activity. So what is the history of this requirement? The basic leverage ratio was not adopted in concert with the other aspects of our capital regime as part of any integrated whole. It is a vestige of the pre-Basel era. So before Basel, all we had was a leverage requirement. And it was their finding fault with this leverage requirement that actually led us to risk-based capital. So indeed, with the introduction of Basel's risk-weighted approach, the banking agencies intended that risk weight standards, not the leverage ratio, would take over as the primary determinant of a bank's capital. After the financial crisis, the largest banks were then subjected to the supplementary leverage ratio, and in the case of GSIBs, the enhanced supplementary leverage ratio, ESLR, which is a more stringent version of the SLR. Importantly, when the banking agencies implemented Basel I's risk-weighted standards in 1989, most commentators argued that the leverage ratio should be dropped because having two separate sets of capital requirements would be duplicative and unnecessary, and the risk-based one was better than the old leverage one. And the agency seriously considered doing away with the leverage ratio, but they ultimately chose to retain it. They were not confident in the accuracy of the novel and untested then risk weightings. And at the time, risk-weighted standards only accounted for credit risk, not market, operational, or interest rate risk, which was also an important part of thinking about bank capital. But we're far along now in the process. Here we are in 2025, and risk-weighted standards have evolved during this period of time. They have since their beginning been supplemented to incorporate market risk and operational risk, and now incorporate complex modeling that did not exist at the time of Basel I. Moreover, interest rate risk is continually monitored by bank examiners as part of the supervisory framework and could be incorporated into risk-based capital if you wanted to do that. We also have several other safeguards in the capital framework that did not exist at that time, like the stress testing regime. So there are strong arguments that the concerns that motivated the retention of the leverage ratio have been mitigated by subsequent enhancements and refinement of the overall capital framework. The leverage ratio is now a frequently binding requirement for the largest institutions, meaning that it requires more capital than the risk-weighted standards. This is inconsistent with the agency's original rationale for retaining the leverage ratio, which was that it would sort of be a backup for the insufficiency of the risk-weighted requirements. Bank capital levels, in conclusion, Harold, are at all-time highs now, well above what Basel and other jurisdictions required. I think we need to step back at this point, which is the whole purpose of this conference, and ask ourselves, with respect to the leverage ratio, not only focus on ESLR, but whether we need it at all. Thank you.
Thanks. Does anyone want to react? What about the issue of intersecting types of capital requirements? Does that cause problems when different banks are subject to different rules at different times? Any views on the panel?
Well, I can offer two observations about the role of the leverage ratio in the broader framework. One is just, I know this conference is primarily focused on large banks, but we do have the community bank leverage ratio for smaller community banks. So there can be benefits in having a leverage ratio for particular institutions. They could have a simpler framework. But I think also the fact that the leverage ratio is itself simple also illustrates one of its potential benefits. We've seen in stress periods, there's often a focus on simplified metrics. That was certainly the case during the financial crisis. To some extent, it was also the case during 2023. It wasn't necessarily the leverage ratio that was a focus, but there was a focus on things, metrics such as tangible common equity or others that are simple. So the simplicity of the leverage ratio, if it's properly designed and calibrated, could play a complementary role both for smaller banking organizations if they wanted to have a simpler framework versus the complexity of calculating risk-weighted assets, but also more generally to have a component of the capital framework that sort of the benefit of it is its simplicity, particularly in times of stress.
There's also the issue of assets that turn out to be more risky than they're modeled to be. And this is a backstop for that. So the obvious example from history is AAA subprime mortgage tranches, which weren't really AAA, but were modeled to be AAA, and capital held against them, and it was a disaster.
Yes, Brian.
I'm just add the when you look at 2023, leverage requirements didn't necessarily catch the buildup in what seemed to be risk-free assets at some banks that ended up having trouble. So I think, and the important thing is, as Ben said, properly calibrated. And it's difficult to perfectly calibrate a risk-based or a leverage requirement in advance. So I think, vigilance and staying on top of, risk is ultimately the key. You can't just rely purely on, either of these. There's constantly new risks emerging. Something like CRTs, certainly growing in use, not very well, not great disclosure around it. It's just, I think, staying on top of those risks as they come up is as important as where these are set.
So some support for the backstop principle. Tiffany?
If I can add to that, the leverage ratio is one piece of the puzzle. So banks are managing to capital, interest rate risk, liquidity, and all of those as part of a holistic risk framework is important. I think about stools on a table. Each leg needs to be strong. And so to Brian's point about interest rate risk management, that individually also needs to be a robust leg to keep the entire table stable. But the leverage ratio itself can't overcompensate and make up for any weaknesses in other areas of risk management.
Hal, did you want to react to anything, any of the reactions to your comments?
No.
No? Okay. I sense a degree of alignment on the panel on this. Okay, Tiffany, you're the Treasury market expert. And as I mentioned, there's been a big focus on the unintended consequences for the Treasury market of this rule. So regulators have cited, in fact, in the proposal, Treasury market functioning as a key reason to recalibrate the leverage ratios. But is it better to lower the leverage ratios embedded in SLR or ESLR and the Tier 1 leverage ratios? Or would it be better to have a more targeted fix to address Treasury market functioning, like exemptions?
Thank you, Daryl. And let me kick off by thanking Vice Chair Bowman and the Federal Reserve for bringing us together today on this important topic. Let's spend a moment on Treasury market functioning. As a treasurer, that topic is so critical. We use treasuries for liquidity management, collateral hedging, and it's all linked to the Treasury market being the biggest, deepest, most liquid bond market in the world. Stands at close to 30 trillion today and growing. So supporting a resilient Treasury market is important for the broader financial system, which we're all invested in. There are two key tenets to that. One is safety and another is liquidity. In terms of safety, there are a range of enhancements already in flight, including the central clearing mandate. In terms of liquidity, supporting and deepening the market for Treasury securities, which is growing, is critical. In our seat, knowing that a Treasury security can be converted to cash easily, quickly, and in all market environments is so important. And that's all predicated on an ecosystem of buyers, holders, sellers, intermediaries. And the intermediation of treasuries is particularly important in periods of stress. At BNY, we have a unique vantage point into the treasury market, and we do see elevated treasury volumes in periods of market uncertainty or stress. In those periods, the market is operationally resilient, but we have seen periods of funding market pressures or dysfunction. And that tends to stem from an imbalance of buyers and sellers in the market. So it is exactly in those moments where having intermediaries who are ready, willing, able to support the treasury market and the continued liquidity in the market is most critical. So that brings us to the topic here today, leverage reform. Leverage ratios across the supplemental leverage ratio as well as the Tier 1 leverage ratio in their current construct can disincentivize banks from intermediating treasuries during those periods of stress, exactly when it's needed most. And another dimension to this is typically in those periods of volatility, there's also heightened balances typically of cash or deposits on bank balance sheets. So banks' ability to act as a shock absorber for both cash and treasury securities can be constrained by leverage ratios as they're constructed today. Now, the proposal offers solutions to that. And there are a couple flavors to that, and there are considerations for each. One flavor is to lower the overall leverage requirement. And that does create extra capacity for banks. However, banks still have the discretion on how to use that capacity. And it may not be there in a period of stress. Another flavor is to specifically target cash and treasury securities and exclude those particular assets from the leverage requirement. And in that case, it's a more direct support for treasury intermediation and for banks to act as shock absorbers for cash in those periods of stress. Now, I'll posit that leverage reform is one facet of a multifaceted approach to support market liquidity. It really goes in harmony with public and private solutions, including government facilities such as the discount window and the standing repo facility, as well as private solutions, including recent innovations such as early morning repo or intraday repo. So taken together, as I take a step back as a treasurer, every day we're focused on resilience and we're managing a range of risk measures: capital, liquidity, interest rate risk, just as I mentioned. And that's just to name a few. And we're thinking about a wide range of scenarios. We like to say better to prepare rather than predict. If I extend that lens to reforms, and having reforms that are also supporting resilient treasury markets in a range of scenarios, that really leans towards taking a holistic, proactive approach, looking at all banks and targeting the risk at hand. And that'll help us target a future shock, because we all know that no two stresses look exactly the same. And so with that, that holistic and proactive approach and discussion is exactly in the spirit of this dialogue today.
Thanks, Tiffany. This issue of exemptions for certain safe assets versus lowering of the leverage ratio number itself came up at our dinner table last night, and there was a range of views, but rather than trying to review those, I'd like to get the views of our panel. So how about a quick run of the panel on whether exemptions in addition to or as an alternative to the proposal would be beneficial overall?
So I would be concerned about exempting treasuries because of the interest rate risk that could be encouraged. Banks would be encouraged, I think, to take with just exempting treasuries entirely. Now, I'd like the alternative in the proposal for exempting treasuries in the dealer that are on the dealer's books that are marked to market and subject to the capital, the market capital requirements. But just a blanket exemption of treasuries, I think would raise other issues that need to be addressed.
Brian, do you have a view?
Yeah, I would just say, while the proposal creates significant capacity today, there could be future states of the world where ESLR became binding again, at least on some banks, and it would be helpful to have something countercyclical to offset that, the trade-offs between different solutions.
Hal?
I prefer the approach that was taken rather than exemptions, but I would say with respect to any of these proposals, we need better data on exactly what the impact of them would be on liquidity in the treasury market in a crisis, given the fact that the dealers only account for, not a lion's share of this market to start with.
And Ben?
In terms of specific exposure exemptions, I think it's important to think about that in the context of the broader framework. We discussed earlier the fact that under the narrow exclusion, there would still be the market risk capital requirements, but also there are many other aspects of the regulatory framework. There are also many aspects of the supervisory framework. So looking at what else is there to address the concerns if there might be exemptions for specific exposures, more of a holistic view.
Yeah, again, we haven't been able to get much disagreement. There was an intriguing remark last night at our dinner table on the implications of exemptions for Treasury securities, which is that in the international financial stability framework, some other countries might be tempted to also depart from the general spirit of the SLR, exempt their own government securities, and in some cases that might have adverse implications for international financial stability. So I'm going to turn next to Brian, and I want to address the issue that's come up already, which Tiffany mentioned, which is resilience. The resilience of the Treasury market to events like March 2020 have been more prominent in the interagency working group papers on Treasury market reform than everyday liquidity. Do you think the proposed reduction in the ESLR is likely to improve Treasury market liquidity on normal days? Would the proposal improve Treasury market liquidity during a crisis? Is there an advantage, and I think you alluded to this a moment ago, to waiting for crisis conditions, as in March 2020, before lowering or exempting from the SLR?
Yeah, great. Thanks, Daryl. And also thanks for having me here to speak today. I appreciate it. So I'd say Treasury market liquidity today, normal times, is generally working fine. You could look across a lot of measures: on the run, off the run, spread, market depth, swap spreads, futures basis, all kind of operating fine today. That said, banks are economic actors, and to the extent there was client demand and you had a significant increase in leverage exposure capacity under the proposal, then I think at least at some of the GSIBs there could be incremental capacity deployed to low RWA activity, which could on the margin improve liquidity on a normal trading day. I wouldn't expect banks to go out and buy a bunch of long duration for their banking book, but think client financing, client intermediation. In terms of the second point around crisis, you mentioned March 2020. I think that's a great example, right? It seemed like balance sheet constraints were contributing to a deterioration in market liquidity, and regulators stepped in, much to their credit, and provided temporary relief, and that helped facilitate return to activity. So I think a SLR that is not regularly binding certainly could and should help reduce the likelihood of a dysfunctional Treasury market in periods of stress. That said, it's just one piece. Daryl, I know you've written and testified about a bunch of the other pieces, so it's not just the one silver bullet, but I do think it would be a helpful part of that process. And then in terms of that final part about, is there advantages to kind of acting before or waiting, I do think it's helpful to have some countercyclical part of it. There's different ways to do that. There's the narrow exemption in the proposal. I think the Basel standard allows for exempting reserves in certain situations. Both of those have some advantages and disadvantages. You're picking winners and losers between low RWA type activities, which can cause some market distortions. You could bucket all low RWA activity together and exempt that as a group, but that could hollow out the rules. You might need to change the requirements. There's different things to do there. You do a countercyclical buffer, or just wait for the next crisis. Generally, I would say the market doesn't like uncertainty, and generally, I would say it's maybe not great policy to be working on emergency measures. To the extent that that path could be explained in advance, the market could discount it in advance, and I think it would lead to better market functioning.
How about some more views? What about this countercyclical approach? Should the agencies keep something in their back pocket ready to bring out during a crisis, or should they try to fix it once and for all? Anyone have a view on that? Tiffany.
Thanks, Daryl. I agree with Brian, and clarity and having the certainty in regulations is important, particularly as we're managing our balance sheets at banks. We talk about looking at various different scenarios and preparing for a range of outcomes. In those scenarios, we're typically not assuming that there will be any change in regulatory requirements. And banks may take action, reduce activity in advance of a stress, expecting no changes. So the structural permanent changes, the advance notice of that, helps steer and incentivize the right behaviors in advance of a stress, and then reduces the need to make any ad hoc changes during a stress period.
Don?
So I've been a fan of the countercyclical capital buffer applied across capital regimes, risk space and leverage. We applied it at the Bank of England. Actually, I can't remember whether it was applied to leverage ratio. I'm looking over at Phil. It was applied to leverage ratio. I think a key, and I've advocated it and been rejected by the Federal Reserve many times. It's a familiar position, but I think the key is it's not just a one-way street that you have something you reduce in hard times. You have to make sure it's adequate in the good times, that you've got the capital high enough that if you release capital in bad times, leverage or risk-based, that the banking system is still safe. So counter-cyclical in both directions.
Other views? If not, I'm gonna move on and ask Ben a question. So Ben, the Federal Reserve Board staff has estimated a $210 billion decline of capital at the GSIB depository institutions, but does that matter for financial stability given the much smaller $13 billion projected decline in capital at the GSIB holding companies? What are your views on that?
Thank you very much. It's great to be here today with everyone. When considered in the context of the broader large bank prudential framework, I think the financial stability implications of the difference are potentially positive. This is particularly the case in light of the GSIB resolution planning framework and the GSIB single point of entry resolution strategy, as well as the design of other Dodd-Frank Act enhanced prudential standards which focus on the holding company. The risk-based requirements are higher for the holding company than the bank, as you mentioned. And this reflects the fact that the GSIB surcharge and the SCB applied only at the holding company level. That in turn is itself illustrative of a key structural feature of the current large bank prudential framework, and that's a focus on the holding company. This is codified in Section 165 of the Dodd-Frank Act, and many hallmarks of the current large bank prudential framework are all holding company standards. Some examples would include supervisory stress testing, CCAR, and then the stress capital buffer, internal liquidity stress testing, TLAC requirements for GSIBs, and then the joint FDIC and Federal Reserve resolution planning requirements. The proposal explains that it would do three main things. First, restore the ESLR to a backstop. Second, address the level and marginal regulatory incentives regarding low risk, low return, and higher risk activities. And third, provide the GSIBs more flexibility in the allocation of capital among their subsidiaries. I think the proposal would actually do three things beyond that. First, it would address the arguably anomalous role of the 6% bank ESLR requirement in the current prudential framework. That's a bank level capital requirement that's calibrated to be higher than for the holding company, but based on the GSIB status of the parent. It's actually the exact opposite structure of the GSIB surcharge itself, which of course applies only to the holding company. Second, there would be more consistency in the overall design of prudential standards with a focus on the holding company. And third, there'd be more alignment with the resolution planning framework, and in particular the GSIB SPOE resolution strategy. Under that strategy, in the event of failure, only the top tier holding company would enter insolvency proceedings. The subsidiaries would be resolved without entering into their own separate proceedings. That strategy depends on flexibility, specifically flexibility for the GSIB to provide capital and liquidity to the subsidiaries based on their needs and resolution from centrally available resources. The strategy, of course, also depends to some degree on prepositioning, which entails having some capital and liquidity already at the subsidiary level. It's a balance between the two. So the proposal would therefore have greater consistency with the structural focus on the holding company. There'd be more alignment with the resolution strategy for GSIBs. And from that perspective, there'd be the perspective to potentially have reduced fragility and stress, promotion of the resolvability of GSIBs, and therefore positive financial stability implications.
Thanks very much, Ben. What about other reactions? Is the fact that the dollars of reduced capital at the holding company is small relative to the depository institution, is that important? Is there sufficient flexibility in capital in the structure of a bank holding company and its subsidiaries? What are your views? Hal, do you have a thought on this? Do you have a thought on this, Hal?
Yeah, so as you said, Daryl, the reduction of the depository level was much higher than the reduction at the holding company level. But I think we need to keep in mind the basic framework in which the holding company of a bank has to serve as a source of strength for the bank subsidiaries. So even though you are reducing the capital level at the depository institution subsidiaries, you have the holding company still with this obligation to support the subsidiaries. So I'm not that concerned because the holding company capital is not being reduced by very much at all.
Don, a thought?
Yeah, so the fact that the holding company capital is basically unchanged is reassuring. I do wonder about the source of strength thing, though, Hal. I mean, once the capital is upstream from the depository to the holding company, downstream to the broker dealer, or if it's not downstream to the broker dealer, it won't do any good, right? So presumably the intent of the authorities is to have it downstream to the broker dealer, then you have a crisis. You have something happens that no one's anticipated. Are they really going to take the capital back from the broker dealer and give it to the depository institution? In 2008, the board was asked to vote several times on exemptions to upstream capital from the bank to the holding company to support the broker dealer. So I think we need to think more carefully about whether the holding company would be actually a source of strength in a crisis situation.
Tiffany?
I think that all folds together to the fact that each bank is managing to multiple risk measures, capital being one, but liquidity, interest rate risk, and other measures will also support both the IDI as well as the holding company. So all of those various constraints ultimately inform how much could potentially be upstreamed or not. So there are additional constraints as part of a holistic risk framework that we are thinking of as well.
Thank you, Brian.
Yeah, I would just add, to Ben's point, the resolution framework for a single point of entry is meant to capture sufficient liquidity and capital at the intermediate holding company to avoid the situation that Don is talking about. Can it effectively do that? It's not clear. Disclosure is not great in that area. So another area where it might be helpful to have more robust discussions around that to give more confidence to more participants that actually could work.
And that's about resolution. So you're in a situation where you're managing a failure. So it'd be nice to prevent the failure in the first place.
Ben, did you have a remark on that?
My only observation is I did refer to reducing fragility, and that's part of the benefit of potentially having greater flexibility. I mean, implicit in that reference to fragility is the possibility that the point of non-viability is higher in 2015 than it was in 2008. So that's, again, a reason why I think it's beneficial to consider the capital framework alongside the resolution framework.
Wow, very complex topic. Don, I want to turn last to you, and you have been an advocate for reducing the SLR in order to make sure that it remains a backstop, as we discussed, and doesn't impede the willingness of dealers to make markets in treasuries, as we've also discussed. But you've also noted an important caveat that any adjustment does not reduce resiliency of the banking system. So when you look at the agency's proposals, how does it stack up against these criteria that you have in mind?
Thank you, Darrell, and thank you for inviting me to be part of this panel to the Vice Chair. So you're right, I've long supported enhancing Treasury market liquidity by making the leverage, the SLR, a backstop. In fact, a senior Federal Reserve official told me a couple of years ago I was using too much of my brain space on the leverage ratio. So I'm grateful to have that space freed up for something else. But as you noted, my support has been couched in the context that it not reduce overall capital requirements and resiliency. And I think I take quite a bit of comfort from the fact that there's no reduction in the holding company level. But I do think, as I just noted, there are things we need to think about. And I still have a few concerns on this overall resiliency issue that I'd like to surface and I hope come up in agency's consideration. First, obviously, making the SLR a backstop puts extra pressure on sound risk-based capital requirements. And I think financial sector resilience is especially important right now. The economy could well be on track for good growth and low inflation. That's what's priced into financial markets. but we shouldn't be lured into complacency. Secretary Bessent last night worried about pro-cyclicality in financial markets. He cited private credit in that regard, but we know banks and bank regulators, from history, we know banks and bank regulators are not immune to this particular disease. And the tails of the distributions around the central tendency seem unusually fat, as we are in uncharted waters with respect to the evolution of the global trading system, the ratio of federal debt to national income, and challenges to the independence of the Fed. So I think the risk of unanticipated developments are particularly high right now. And it would be preferable to evaluate this proposal as part of a holistic review of all capital requirements. In that respect, this is a terrific conference putting all this together. There's so many in the risk-based capital. There's the Basel III Endgame, GSIB requirements, and the stress tests, and how are they all going to fit into this? So were risk-based capital requirements the first line of defense weakened, I'd need to rethink my support for reducing the backstop, and I urge the agencies to put the whole package together before signing off and in one piece. And the second point, I want to come back to something that came up before, and that is releasing capital at the DI will not reduce the resilience of the overall organization, but you will be encouraging. In fact, one of the benefits cited in the thing is encouraging banks to buy treasury securities. So it does expose them to added interest rate risk, widespread losses on treasury and agency securities contribute not only SVB's problems, but the risk to the broader system that triggered extraordinary actions by the authorities in March of 23. So banks should be required to mark securities in the available for sale portfolio to market, and the available for sale portfolios should be subject to market risk capital requirements. Bank interest rate risk management, even for the hold to maturity portfolio, should be subject to close scrutiny. And as I noted, my concern about interest rate risk would make me very reluctant, would make me opposed to exempting all treasuries from the leverage ratio.
So the gist of your remark is that you want to see the whole package before a final view on it.
Yes.
Yeah, interesting. And other, Hal, what's your view on this?
So I think we need to keep in mind that the U.S. banking system is today very well capitalized. U.S. GSIB actual capital levels have increased 17% over the past 2 years, and our minimum capital requirements are now 1.7 times higher than the Basel requirements, 837 billion versus 473 billion under Basel, because of our stress testing regime and gold plating. Keep in mind that we gold plate the Basel requirements. This proposal does not reduce risk-based capital. It merely moves leverage into the background where it always has belonged, and in my view, we could do away with, okay? And if it's in the background, you can further say, why do we need it then? If it's now in the background, it's not binding anybody. Okay, so anyway, I think overall the US banking system is in a very good place today in terms of its actual capital levels.
Hal, you mentioned gold plating. I'd like to get a reaction to something that came up, another topic that came up at dinner last night, which is the implications of the SLR and other regulations on the ability of US banks to compete both with non-bank financial institutions and with international banking institutions. First, is that competitive angle, does it figure in your minds as an important aspect of the rule change? And secondly, is it actually true that US banks have been at a, or GSIBs have been at a competitive disadvantage because of the capital requirements that we've been discussing?
Daryl, quite frankly, don't know the answer to that, but I would be skeptical. I think there are a lot of other factors that affect competitiveness. I mean, You know, when we originally adopted Basel, it was because of competitiveness concerns with the Japanese banks, right? And we said, well, get them on an even playing level, they'll have to have the same capital level as we do. But then it turns out they have different accounting systems, they have different government subsidies, they have different forms of regulation that have nothing to do with capital. So you have to add all of that into the picture when you're thinking about competitiveness.
Any other reactions on competitiveness? Brian?
I would just say, certainly, we have a higher SLR requirement than other jurisdictions, although that does not seem to have stopped our banks from competing very well against a lot of the international banks. I think certainly non-bank financials have, significantly increased their scale and scope in some of these businesses, and obviously they don't have the same regulations, so that might have merit.
Is it, and moderators don't get to vent their own views, but it does seem like better capitalized banks are better able to compete in principle.
Yeah, that was the point I was going to make. I don't think the UK, European, Japanese banks would think that they're at an advantage because their capital hasn't been gold-plated. I think the US banks are pretty much competing very, very well in the international field. And there are times when being well capitalized, having high capital is to your advantage because, of course, under stress, there's much less to worry about. We saw that in the U.S. in the March 23 situation where deposits fled from regional banks where people were concerned about the embedded losses on treasuries and other things, and they fled to the GSIBs. And some of the commentary, well, that's because the GSIBs are too big to fail. But I think it was also because the GSIBs were much better capitalized and much, much less likely to fail.
Okay.
I'll make one observation, which
Yes,
is
go
that
ahead, Ben.
you receive a lot of questions about the regulatory capital or liquidity treatment about particular transactions or products and things of that nature. And that does clearly illustrate that their marginal incentives and essentially what the marginal capital cost, liquidity cost does factor in. That's not necessarily contradictory, but I think it does show that that actual marginal effects of regulation do factor into business decisions. And there are differences between US and non-US requirements.
Tiffany, at a global bank.
Well, I was going to re-highlight some of Don's points. One being completely support interest rate risk management. It's a strong pillar. It's an important risk pillar. And as I mentioned, it's an important part of the overall risk management framework for banks. Second, the holistic review, I think, is an important point as well, because we find that, again, managing to a lot of risk measures, making a change to one risk measure is likely going to have another become binding over time and could have the same constraints, let's say, on the treasury market. So I think that holistic review is also makes a lot of sense.
Terrific. Okay, I think we got a pretty good sense of the views of the panel, and I think it's time to turn to you all. If you have a question, would you raise a hand? I see there are microphones. Would you also please identify yourself and try to keep it to a question, just one. If we have a second round, we can come back, and not a speech, just a question, please.
My name is Guowei Zhang. I'm with SIFMA. My question is, as you know, currently category 1, 2, 3 banks are subject to 2 leverage ratios. One is supplementary leverage ratio. The other one is tier 1 leverage ratio. And the question is, why do you think 2 ratios, both target leverage, are needed for these banks?
Okay, I'm going to ask anyone that can address that question, because I don't want to handle that one. Hal, do you have a thought on that?
I'm not going to defend one of 2 ratios when I disagree with both of them.
Okay. I'm watching for hands. Yes.
Hi,
Sharon.
Sharon Ishai from Morgan Stanley. I actually have a question directly to Don. You mentioned that you think that we should have a countercyclical buffer. You mentioned overlap between different parts of the capital regime. You mentioned that it was something that made sense in the UK, but at the same time, the US has a much different capital regime, inclusive of the CCAR test, for example, which does give you an ability to build capital to be there for stress. And so I'm curious as to why you would want to impair potential use of capital from the banking institutions in a period of stress where they could be using it to lend and still put on an additional countercyclical buffer on top of that. So it's almost as though the concept behind having overlap is not necessarily taken into account from a buffer mentality where you don't necessarily have the CCAR exam in the UK.
Yeah, so I certainly think there's simplification and the two leverage ratios and overlap between things. That's why this is such a great event today, because the authorities can hear views about how these things interact and whatnot. But I do think my countercyclical buffer thought, or at least the way we exercised it in the UK, was exactly to free up capital in a stress event. And by lowering by taking out the counter-cyclical part, you enabled banks to use that capital without running into restrictions on dividends and buybacks and that kind of thing. So our view, and I think as I've read the studies that came out of the March 2020 COVID thing, that for countries in Europe that had counter-cyclical buffers, they found that the ones that released those buffers had better lending experiences than the ones that didn't. So maybe I didn't understand quite your question totally, but the whole point of the counter-cyclical buffer is to encourage lending in stress situations, or discourage having a constriction of credit add to a stress situation.
Alistair. Oh, sorry. Yes, you. Thank you.
Bill Demchak, I'm
Sorry,
the
Bill,
CEO of
pardon me.
PNC. Just an observation, this entire conversation on leverage ratio and then pointing to the functioning of the treasury market. What we're actually talking about is the ability of prime brokers to increase their balance sheet in times of stress. So the noise around, hey, banks are just going to go buy more themselves up because they can take more interest rate. We're not going to buy any more treasuries. We can get duration 100 different ways without going to the treasury market. We could do it off balance sheet through swaps. What we're simply talking about is it a good idea to give GSIBs the ability to grow their prime brokerage operation to support the actual capital providers into the treasury market today, which are principally hedge funds. And by the way, I am in favor of that, but I would reduce the conversation to that, because I think our issue ultimately becomes the size of prime brokerage across Wall Street as opposed to what the leverage ratio is.
So Bill, would the support for hedge funds and others through prime brokerage increase in a stress? So I think one risk, isn't it, that this actually enables the hedge funds to become more levered?
Yes.
Because banks, and now you've got a stress hits and the margins start increasing, and the pressure on the hedge funds, the basis trade blows up even worse.
You're picking your poison, but that is the correct discussion. So banks, since I worked on a primary dealer desk 30 years ago, they don't take down the auctions anymore, right? We used to, we no longer. The hedge funds bid the auctions. The big banks finance the auctions. If you get an off-the-run treasury that won't trade because it's unfinanceable, you get disruption and dislocation. So you want to be able to finance it. You say, all right, well, I want the treasury market to function because we're running the biggest deficit we ever had, and it's likely to grow. So therefore, I need to get capacity to make this thing work. I need to expand primary deal, the prime brokerage, central clearing, a whole bunch of other things to allow that to happen, all of which I'm in favor for. But I'm simply saying that we're consciously choosing to ask banks to finance a larger portion of the principal positions of the players in the treasury markets. That's what this rule is about.
Yes, Pete, a question right here.
I have a follow-up actually to Bill's observation.
Could you give your,
Sure.
your name?
Peter Blostein, PB Investment Partners. So a follow-up to Bill's question is perhaps heretical, which is to ask, are there other rules that should be addressed if we're trying to get more treasury market liquidity, namely proprietary trading in the Volcker rule? Should banks rebuild relative value fixed income desks that all migrated out of the banks post Dodd-Frank, post Volcker, and that should be the place for treasury market intermediation rather than hedge funds, as Bill suggests? Just an off-the-run thought. Thank you. I'm curious if any panelists support that view.
Any views, panelists?
Well, I think in the context of looking at and taking a look at regulations overall, it's an important holistic piece of the discussion today. I do think in the context of intermediation is one piece of the treasury market. Certainly that is a very important activity during a period of stress. But to the point of it's a 30 trillion, close to 30 trillion market today, growing. Intermediaries are one player in that market. Buyers and holders across all different banks is something that we need to and should consider to continue to support that market. So that's the kind of broad view, and looking at broadly regulations overall is, I think certainly the leverage ratio is a step in the right direction, but taking that big picture view as part of that holistic discussion that we're having here today as well.
Subjected to market risk capital.
Market risk, interest rate risk management.
Interest rate
Yeah.
risk management, right.
The proposal does cite some research, for example, by Falk Breining and Hilary Stein at the Federal Reserve Bank of Boston, showing that those dealers that were relatively more constrained by SLR provided relatively less liquidity to treasury markets in the March 2020 event. And more recently, a Federal Reserve Board study by Mary Tian and her co-authors showed that those banks that have more headroom under the supplementary leverage ratio provided more financing, to Bill's point, in the treasury market. So there is some research in support of what you're all saying. Other?
Daryl?
Yes, Hal?
So I understood the question basically was, let's get rid of the Volcker rule so we can have more prop trading that could actually help the treasury market. Fine. It's the implication. Okay. Okay. So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected in Massachusetts. So I remember the Senate hearing on this and the Democrats being puzzled about why we were even doing this. If prop trading would help the treasury market, I would be in favor of re-examining the Volcker rule. But I want to caution everyone as we talk about all these changes, there is legislation to consider here. This is not something that the Fed or other regulators can easily do on their own. A lot of these changes are embedded in statutes, okay? Now, maybe the president can be creative with executive orders in this area, but as we proceed on this line, we have to ask ourselves, how much can the regulators do without legislative change? And that's a big constraint, okay, in this picture.
Just to be clear, in the legislation, the treasury market is exempted from the Volcker rule, so it doesn't really restrict proprietary trading in the treasury market. So let's have another question.
Daryl.
That's not true? Treasury securities are not exempted from the Volcker rule? I think they are. Al?
Daryl. All right.
Sorry.
Norbert Michelle, Cato. Hi.
Yeah.
Sort of an efficiency question along those same lines. If we're worried about specific activities, okay, and if we're worried about source of strength actually being source of strength at the holding company level, why aren't we more worried about the capital at the IDI level as opposed to holding company level?
So let's revisit that. Anyone have a reaction on this issue of capital at the insured depository versus the holding company? Ben, you have your
Yeah,
light on?
I think capital at the insured depository institution level is a relevant consideration, but we're looking at it today from a level that's high based on a leverage requirement that's also uniquely applicable at the GSIB IDI level, which is just not aligned with the general framework that we currently have. And so it is important to balance what's at the holding company, what's at the bank. And as I was expressing earlier, I think this rule would strike a better balance, but that doesn't mean that going lower is forever going to be a better thing. It's that it's necessary to balance all these things. So it's that this rule strikes a better relationship with the broader framework, in my view.
Okay, I'm watching for hands. I'm also watching the time. We have a couple more minutes. Yes, now Al.
Sure. Thank you. Al Moffat, JP Morgan Chase. So there's been a lot of discussion just early about the role of the leverage ratios as it relates to the role, particularly the value of changing the SLR for the IDI and the consequence on deposits and other low risk activities like that, even if they